In 2024 and 2025, Indian chemical stocks were the forgotten children of the bull market. They faced high raw material costs and a global slowdown, meaning some of the best stocks in India, like PI Industries, have given zero returns over 5 years. But as we sit here in February 2026, this cycle has officially turned. Today, I'm going to show you 5 stocks that are perfectly positioned to lead the next 5-year bull run. India's market share in global chemical exports is expected to jump from 3% to 9% in this decade. When global giants like Apple or Tesla move to India, they don't just bring assembly lines. They bring a massive demand for specialty chemicals, adhesives, and electronic-grade materials. SRF Limited is the clear winner here. Also known as the Reliance of Chemicals, SRF offers stability through diversification across packaging, textiles, and chemicals. The company is investing heavily over the next 2 to 3 years, specifically in fluorochemicals and pharma intermediates. SRF is also adding a 10,000-ton capacity for hydrofluoroolefins with a 1,100 crore investment. This project is expected to commission in FY27 with major revenue hitting the books from FY28. The second stock is Atul. Atul is a diversified player that has underperformed the Sensex recently, making it a contrarian play. Despite margin pressure, it reported its highest ever quarterly sales in Q3 FY26. Its price to book ratio of 2.9 is also significantly lower than peers like Deepak Nitrite or SRF. At a PE of 32.8, Atul is trading at a premium to its peers, but it is historically fairly valued compared to its own 5-year average. The company maintains 1,200 crores worth of surplus funds, which is dry powder that allows them to fund massive future expansions without taking on expensive debt. While their ROC has been lower recently, analysts forecast a return to 15 to 18% ROC as new capacities reach full utilization by 2027. Atul is a buy on dips for long-term investors. It lacks the explosive volatility of newer names like Netweb or Keynes, but it offers a much safer floor. The third stock is Fluorine. It is currently the strongest technical performer in this sector. It has successfully pivoted into the high-margin CRAMS space. It just reported an astounding 121% year-on-year jump in net profit. It is trading near its 52-week high as well, having delivered a 60% return over the last year. As of Feb 9th, it flashed multiple EMA crossovers 10, 20 and 50-day. Analysts see an immediate upside towards 5280 if it holds its current momentum. This Nvidia of Chemicals owns the complex fluorine chemistry required for both high-end pharma and EV battery cooling. Analyzing Fluorine International for the next 5 years puts us in the driver's seat for the fluorine revolution. While Atul is the stable fortress and SRF is the diversified giant, Fluorine is the high-margin specialist with the most aggressive growth projections in this sector. The fourth stock is Ether Industries, which my regular subscribers would know I'm a fan of. Analyzing Ether Industries is an exercise in valuing R&D-led innovation. While legacy giants like Atul and SRF scale through volume, Ether scales through chemical complexity. The primary reason to hold Ether for 5 years is its strategic shift from a product-led company to a partner-led company. The management is targeting a revenue mix where 70% comes from CRAMS and CEM, up from the current 50%. CEM margins are typically 27 to 30%, significantly higher than bulk manufacturing. The 2025 strategic partnership with Milliken & Company is just the first of several planned multi-year exclusive deals. These contracts provide 5 to 10 years of revenue visibility, making the business stickier and less prone to commodity price swings. The commissioning of Site 5 in Panoli in early 2026 is a massive growth trigger. With Phase 1 coming online, Ether is adding the capacity needed to service the global semiconductor and material science sectors. If they successfully transition to a 70% CRAMS model and the semiconductor vertical takes off in Japan and Taiwan, this stock could be a multi-bagger from current levels. The fifth stock is Clean Science and Technology, and it's a long-term story which is about transitioning from a few niche products to a diversified performance chemical giant. The core reason to hold Clean Science until 2031, say, is their aggressive entry into HALS or hindered amine light stabilizers. Historically, the company has relied on 4 to 5 products for 80% of its revenue. Through its subsidiary Clean Phenochem, they have built India's largest HALS facility. HALS is a high-growth segment used in plastics, paints and UV protection, and currently, India imports a large portion of its HALS requirement. Clean Science is positioned to be the primary domestic supplier, aiming for a 25% CAGR in this segment alone through 2029. Beyond HALS, the company is commercializing hydroquinone and catechol derivatives. They are moving into water treatment chemicals as well, which adds a new recession-proof revenue stream. A bonus stock is my favorite multi-bagger, PI Industries. By 2031, PI Industries will no longer be defined just by pesticides. Its growth will come from three distinct high-margin platforms: the AgChem CSM Fortress, where PI remains a global leader in custom synthesis and manufacturing. With an order book exceeding $1.2 billion and 20 plus new products in the pipeline, this is the cash cow that funds all their expansions. There's the pharma pivot, which is the biggest alpha generator. In the 9 months of FY26, pharma revenue grew by 50%. Through its acquisitions of Archimica from Italy and Therachem, PI is now a global CDMO player. Analysts expect pharma to contribute 15 to 20% of total revenue by 2030, up from about 4% today. And finally, the Bio-Pharma Shakti tailwind that benefits PI Industries. The 2026 budget's 10,000 crore initiative for biologics directly benefits PI's new state-of-the-art biological R&D center in Hyderabad. They are moving into peptides and eco-friendly biopesticides, which command higher premiums. As the global crop protection cycle bottoms out in 2026 and the pharma CDMO business hits critical mass in 2028, PI could see a doubling of its market cap within 5 years.